Thanks for joining. Before we get started, please click subscribe to my channel and check out a message from our sponsor, The Motley Fool, where you can get the top 10 stocks to buy right now. So Crown Castle is usually one of the first real estate investment trusts to report earnings, and this quarter was no different. We've heard their results a couple of weeks ago now. And at first glance, the guidance looks kind of disappointing. Their FFO per share it grew 6% year over year in 2022. They're expecting 3% year over year growth in 2023. They're expecting some income to their other income metrics to kind of drop accordingly. And I know a lot of it is due to what happened with Sprint and T-Mobile, two of their biggest tenants, when they combined. So to make a little sense of it, Tyler Crow is joining me. Tyler, why is Crown Castle's growth slowing down so much, and how much of it is due to the Sprint and T-Mobile thing?
Yeah, it's weird. It feels like Crown Castle should be at an inflection point where it should be growing faster. One of the things that they really leaned into over the past few years is deploying not just cell phone towers, which is kind of their bread and butter. It's one of the very few cell phone tower operators. It's a great business, especially over long term. But they really plowed into building out fiber networks and small cell nodes, which is basically like small units to broadcast telecommunication signals in like urban areas, places where you need a lot of capacity to use it. They've been building this out a lot. So you'd kind of expect, like with 5G rollout and capacity build out, this would be like a good, fast growing part of the business. And like probably Crown Castle should be, doing above trend growth right now because of it. But they're throttling back. And one of the things that you just mentioned is the Sprint T-Mobile merger. And that's where things get really weird. Because of that merger, Sprint and T-Mobile don't need like overlapping things on the same tower. And so over the next 3 years, through fiscal 2025, they're going to be not upping new leases on some of their towers. Now, as a result, they expect, significant increase in their non-release rates, specifically because of this merger. Management says on their 10Ks, we expect 1% to 2%, which is normal for cell phone tower REITs. Not everyone renews all the time, but because of this, we're going to have an elevated number. And as a result, having to release that and not having that revenue coming in for these investments is going to really throttle back growth for the next few years. And for me, that's kind of hard to digest when I'm trying to make a decision on this stock, because 4% yield right now looks pretty good, but with such tepid growth of the next 3 years and in a higher interest rate environment, I'm not super jazzed about this. I feel like there are better opportunities over the next couple of years. Maybe if we were to see, better valuation, it might make sense, but I don't see it right now.
Yeah, Crown Castle's generally been a relatively expensive REIT over the past few years. Just on a price to FFO basis and things like that. And to be fair, it's deserved the multiple. It's delivered results for a while. But I got to agree with you that with the slowing growth expected over the next few years, there are a lot of other opportunities in the sector that get me a little bit more excited than Crown Castle right now. I love the long-term thesis. To be very clear, I think the long-term thesis is still very sound, and that we're still in the early stages of building out a modern communications network in the United States. But over the next few years, it might be a little muted. Like you said, it's one on my watch list if we get an opportunity to buy it cheaper. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.